What can yield do for you in your portfolio? Whether it's a conservative approach in the 5% range to the more aggressive approach in the 39% range. Hopefully you stick around this video. I hope to give you some examples, shed some light on different portfolio mixes with different fund managers. Let's mash up the yield from both ends of the spectrum to see what we can get. For the purpose of this video, we're going to be using a dividend calculator provided by MarketBeat. They are not sponsoring this video. Just happened to run into this as a decent tool that you can use actually on their website, which I will link down below in the description, or you can actually just download the Excel or if you're into Mac, the numbers version of it. So let's get right into it. We can also change the inputs in here, but for now I'm just going to be using the $10,000 example. Treating it almost like a TFSA with the annual contributions at $6,500. We can change to the dividend yield here. Dividend tax rate 0 because it's a TFSA. Expected annual dividend yield increase, I'm going to say 0 because typically how these funds work is they don't naturally grow their own, say, distributions like they do with, say, regular dividends that companies pump out. Expected annual share price appreciation, again, it's 0. If you're into covered calls, this is not something you're going to necessarily be focused on, or at least it's not for me. So with that being said, let's get into the first batch of funds. This mix, I just figured that this might be something that you are just starting to get into with covered calls, maybe as a side complement to a hybrid strategy where you're already in dividends, but you also have some growth expectations from certain stocks that maybe don't pay a dividend. I chose ZWC. That was the first one I ever started out with. High dividend covered call ETF. BMO rates covered calls on 50% of the portfolio, meaning the other half gets to fully participate in share appreciation, whereas the other half is just more or less in the covered call position to generate some yield at 7.6%. So we could use just that. Maybe you want to add some US mix to it that is constructed the same way. Also gave this example. It's a lesser known by Evolve, where it is a Canadian covered call ETF fund manager where they invest in the S&P 500 and the TSX 60. I believe these are the only funds that do so, but they were interesting to me as they write covered calls on 33% of the portfolio. So 66% gets to participate in full upward momentum, yet they also pay a really generous 8.8 and 8.2% yields respectively. So what could be the downside of something like this? They just have really low volume, which means not many units are being traded on a daily basis, which means you could potentially be paying more for it. That being said, let's start with just an average yield of 6.86 for this example. As we go to $10,000, 6.86 will get you by, say, year 10, $6,840. So let's remember that for the next batch of funds that we're going to look at. Okay, and just to show you the increase, the 1% increase in yield, if you go from, say, 6.86 to, say, 8, you're going to see a massive jump in your yearly distributions. So multi-sector, multi-manager. So I decided to kind of choose a bunch of different sector specific from different fund managers in Canada. You got the top two are BMO with the Canadian banks, Canadian utilities from CI. You got the tech giants, so this is going to be more US focused, and ENCC, Canadian oil and gas covered call, HHL, Harvest Healthcare, Healthcare Leaders Income Fund. These two are going to be a lot more US focused, but at least you get a little bit more country exposure in both Canada and the US. Another reason why I also chose these were they were also higher volume funds, so you shouldn't have an issue with, say, paying more if you were to buy them at scale. So at $10,000 with the $6,500 contributions yearly by year 10, you are looking at basically $12,000. And if you guys remember, we were at about 8,000. What were we at? Let's just go back to year 10. We were at $6,800, whereas here we're basically at a $5,000 increase, and we went from 6.8%, I want to say, as our average yield to 10%. So a 3% increase just gave you 50%, call it increase, if that 40 to 50% increase in yield. So for every basically 1%, man, it makes a massive difference with that amount. Okay, let's go over to the all-in-one funds. For those who are really familiar with covered calls, these names are not going to shock you by any means, but for the newer to intermediate people who are not as familiar with these funds, HYLD, HDIV, HDIF, and BMAX are essentially make these funds obsolete. They basically have all of these funds in each of these. So they eliminate the task of having to, say, invest in individual sectors. You could just pick up the one fund and it'll invest in a variety of other ETFs. That's basically what it is. All-in-one just means it's a fund of funds. An ETF that invests in a basket of ETFs. So you got HYLD, which is the darling ETF of Canada with a very amazing yield of 13.77%. I hold this in my TFSA. I'm going to max it out with just this fund. You have HDIF, which is the Canadian all-in-one fund. Basically, it's the counterpart to this, which I'll put into a taxable account whenever I max out my RRSP. HDIV is it's a mix of Canada and the US, and BMAX is more defensive, again, kind of more structured like HDIV. But you're getting 10.86% yield. So on a $10,000 investment, you will be getting, with, again, our $6,500 contribution. By year 10, you are making almost $14,000, whereas in our last example, now this is barely a 1% increase, you were making just $12,000, so a $2,000 increase, making it to be more like a 15 to 20% increase in overall fund distributions yearly. Okay. So with that out of the way, fund of funds, it makes things simple. I would consider these core. I'm going to make them core. But for now, HYLD simply sits in my TFSA. Okay, let's go over to US index focused. And all of these funds you can find within HYLD, the darling ETF of Canada, as I mentioned. Some of these are old dogs. They've been around for a while. The Global X funds, I believe their inception was 2011. JEPI and JEPQ are newer. JEPI and XYLD are kind of more similar. They track the S&P 500, JEPQ, and QYLD, the NASDAQ 100, whereas RYLD follows the Russell 2000, the lower to small to mid-cap companies within the U.S. And they also produce a very, very juicy yields in the average, if you were to average them out, 12.52%. In my RSP, I actually keep XYLD. So for my own investing purposes, it's HYLD in my TFSA, XYLD in my RSP. Okay, so on that $10,000 investment, again, $6,500 contribution. By year 10, you are making $17,500 at 12.54%, whereas at the 10.8%, 8% at year 10, you were making $13,719. Okay, so a good, nice, healthy increase there. Okay, now we get into the ultra high yielding returns. So to me, I believe there's three really interesting ones, which is OARK, SFL, and HYGW. And I'll explain exactly what each of these are. So the YieldMax Innovation Income Strategy, OARK is a ETF that invests in a single ETF, which is Cathie Wood's ARK ETF, which invests in trend-setting, thematic information cloud computing companies that are, I would say, really susceptible to massive jumps in their share price, right? It's basically the excitement that drives the companies within the ARK funds. But this fund, with its cover call structure, they buy calls, they sell puts, and then they write calls with treasury yield. It's a complex fund, and to get this 39%. It's been out for about 4 months. Then we have SVOL, which is a simplified volatility premium. This one invests in the VIX index, which is the volatility index, which basically tracks how turbulent the overall market is. So it writes cover calls on the fund, but it also shorts the VIX. It shorts the volatility index. So basically when that index is going down, that's where you're making your premiums. And then we have HYGW, which is the iShares high yield corporate bond buy right strategy, which the entire portfolio has 100% of it in the cover call position at the money. And so far, it's again, all these funds haven't been around for that long, but at 28.73%, nothing to sneeze at. The average yield is 28.63%. Not that I would invest in these 3 funds solely. They are American listed only, so you can't get these on the Toronto Stock Exchange. Again, I have to convert your money over into American to buy these funds. But at 29%, if you were to have a $10,000 investment and contribute $6,500 each year by year 10, if somehow these funds were able to continually pay at this rate, you'd be looking at $110,000 portfolio by year 10. But like I said, I think these funds should be used more sparingly and used to just complement your portfolio, maybe boost an angle of your portfolio. I am planning to have, before age 40, a portfolio that generates about $100,000 in distributions yearly. I'm currently 33, so I plan to do this before my 40th birthday. And I actually see a way of how these funds can actually help me out with that. But between all of these funds, probably no more than 10%. Okay, so just as a way of doing some extra fun with, say, these funds, I was kind of playing around with some numbers. And if you had a $100,000 portfolio with the yields of HYLD and XYLD, your yield would be around 14.25 with, again, the $6,500 contribution. By year 10, you're looking at $71,000 at 14.25%. If we go back to the US index focus portfolio, by year 10, we are at, well, let's just put in what happens if we do this at $100,000. Whoops, let's do this at $100,000. For year 10, you're looking at $54,000 as opposed to 2.5% increase. You're looking at 71%. So it just goes to show yield can make a huge difference when it comes to total return. Okay, with that being said, hopefully you all enjoyed the video and it wasn't too long-winded for you. If you like what you saw, then please do the cliche thing and smash all the buttons of the like and subscribe variety. Any questions, let me know in the comments below. I would love to interact with all of you. You can check me out on Blossom. That's where you can see all my live trades. Not that I make many of them. It's basically when dividends come in and when I get paid off of my paychecks. That's when I'm re-upping in my HYLD position. So with that being said, I will see you all in the next video.